In many industries, business credit follows relatively predictable patterns. Revenue is steady, margins are measurable, customer relationships are long term, and payment cycles align closely with operational activity. Traditional business credit models were designed around these assumptions. Transportation does not operate that way. Freight moves faster than money, margins are thin, customer relationships can shift overnight, and payment often trails performance by weeks or months. Yet, despite these realities, transportation companies are frequently evaluated using generalized business credit frameworks that were never designed for this environment. The result is a persistent disconnect between how credit risk appears on paper and how it actually develops within freight operations. In this video, we'll dive deeper into understanding why transportation credit is fundamentally different, why it must be evaluated differently, and why this understanding is essential for brokers, carriers, shippers, and financial partners navigating today's market. We'll first discuss speed of transactions versus length of payment cycles. Transportation is defined by velocity. Loads are quoted, booked, and delivered quickly, often within days. Brokers extend credit the moment a load is tendered. Carriers commit resources immediately. Shippers receive service up front. Payment, however, moves far more slowly. 30 to 45-day terms remain standard, with longer delays not uncommon. Disputes, documentation issues, and cash flow management can push settlement even further out. This creates a structural lag where financial exposure accumulates rapidly, while repayment signals arrive much later. Traditional business credit models struggle with this mismatch. In slower industries, extended payment cycles often align with predictable cash flow and stable customer behavior. In freight, delayed payment can mask stress, aggressive growth, or rising liabilities that are not yet visible in standard reporting. Transportation credit must account for the reality that risk develops in real time, while financial indicators surface only after exposure has already occurred. Next, we'll look at volume over margin, a distorted signal. Most traditional credit frameworks prioritize margin stability. Businesses that generate consistent profit percentages, even at a modest scale, are often viewed as lower risk. Transportation flips this logic. Freight companies operate on high volume and thin margins. A broker may move millions in freight while retaining only a small percentage as gross margin. Success depends on throughput, efficiency, and discipline, not markup. This creates a credit distortion. High revenue can appear strong on a general business credit profile while masking significant exposure underneath. A sudden change in customer behavior, pricing pressure, or volume can destabilize cash flow quickly, even if historical performance looks healthy. Volume-driven models also amplify concentration risk. A small number of customers can represent a large share of receivables. When one fails to pay, the financial impact is immediate and severe. Transportation credit evaluation must look beyond top-line revenue and understand how that revenue turns, how concentrated it is, and how resilient the operation truly is. Next, we'll explore contract freight versus spot market exposure. Freight is sourced through two fundamentally different models, contract and spot. Contract freight offers longer-term agreements, predictable lanes, and negotiated rates. While not risk-free, it generally provides more stability and planning visibility. Spot freight, by contrast, is transactional and highly sensitive to market conditions. Credit risk behaves very differently across these two segments. Spot-heavy operations experience rapid shifts in customer mix, pricing, and payment behavior. During tight markets, spot exposure can look exceptionally profitable. In softer markets, the same strategy can lead to overextension, relaxed credit standards, and exposure to weaker counterparties. General business credit frameworks rarely distinguish between these models. They assume continuity where none exists and evaluate relationships as static rather than fluid. In transportation, today's customer may represent only a fraction of tomorrow's exposure, or may disappear entirely as market conditions change. Effective transportation credit analysis must evaluate not just who a company works with, but how those relationships function and how quickly they can change. Now, it's important to discuss why traditional credit bureaus struggle with transportation data. General business credit bureaus are designed to aggregate financial signals across industries. They perform well when payment behavior, trade lines, and reporting follow conventional patterns. Transportation often does not. Payment timing can fluctuate due to rate confirmations, accessorial charges, or documentation delays. Receivables may be partially factored, self-funded, or settled through intermediaries. Reporting can be fragmented, delayed, or inconsistent, not because of bad intent, but because of how freight operates. Without industry context, traditional models may misinterpret these behaviors. They may penalize normal freight operations while overlooking early warning signs, such as rising exposure velocity, deteriorating payment trends, or lack of recent reporting. This is where transportation-specific credit reporting becomes essential, not to replace general business credit, but to supplement it with data that reflects how freight actually works. Let's now look at what transportation-specific metrics actually predict failure. Transportation failures are rarely sudden. They are usually preceded by subtle shifts that generalized models are not designed to detect. Payment trend changes matter more than static scores. A gradual increase in days to pay or inconsistent settlement patterns often signals stress well before defaults occur. Accounts receivable aging provides critical insight. Rising balances, elongated cycles, or uneven payments can indicate overextension, customer concentration risk, or operational strain. Exposure velocity is another key factor. How quickly a company accumulates credit exposure relative to its ability to absorb losses often predicts failure more accurately than historical averages. Participation in industry reporting ecosystems also matter. Companies that actively report and maintain visibility tend to manage credit more deliberately. Gaps, silence, or outdated information frequently correlate with unmanaged risk. These are the types of indicators that transportation-focused credit reporting platforms, such as TransCredit, were built to track, not because transportation needs more data, but because it needs the right data. And finally, we'll look where transportation-specific credit reporting fits. Transportation credit reporting exists because general business models will never design for freight. Platforms like TransCredit focus specifically on transportation payment behavior, accounts receivable trends, and industry participation. Rather than treating freight companies like generic businesses, transportation credit reporting evaluates them within the context of how freight actually operates. This approach does not replace traditional credit tools. Instead, it fills the gaps they leave behind, providing visibility into payment performance, exposure patterns, and behavioral trends that general models often miss. When transportation credit is evaluated through an industry-specific lens, risk becomes clearer, decisions become more informed, and losses become more preventable. In conclusion, transportation credit is not broken. It's just misunderstood. Freight operates at a different speed, on different margins, with different risk dynamics than most industries. Evaluating it through a general business framework will always produce blind spots. Transportation-specific credit reporting exists to address those blind spots, not by making credit stricter, but by making it smarter. In an industry where freight moves faster than money, understanding why transportation credit is not comparable to general business credit is no longer optional. It is foundational to sustainable growth and long-term stability. As always, we appreciate you for watching and remind you that this information and more is available on our website at www.transcredit.com. We hope you continue to gain valuable knowledge to help in your day-to-day operations. Don't forget to like, comment, and subscribe to our YouTube channel at TransCredit. We'll see you on the next one.